Welcome, everyone. My guest today is Marina Walsh, the Vice President of Industry Analysis at the Mortgage Bankers Association, to talk about the MBA's forecast for 2026. Before we jump in, I want to say thank you to our sponsor, Trust and Will, for making this episode possible. Marina, welcome back to the podcast.
It's great to be here, Sarah.
It is great to be here, especially in person at MBA Annual at the conference. Of course, you gave an amazing panel up there with Joel and with Mike Fratantoni, and so wanted to kind of dig in on some of the economic things you talked about, specifically, some of the good news that we heard. So let's dive in there. Let's talk first about what you guys are projecting for origination volume for 2026.
Well, the good news is that originations volume is going up.
That's
it's
good.
8%. It's something. It's going up to 2.2 trillion,
okay.
And similar percentage, 8% based on units. So that's all good news. In terms of the split between purchase and refi, we're thinking probably about 2/3 purchase and then 1/3 refi. So certainly an improvement over what we saw in 2023, 24, but it's going to pretty much flatten out over the next 3 years, though. So we're not going to see any huge spikes, just incremental improvements.
What do you say, I know that there are some lenders who are staffing up for a refi boom, a small refi boom. What's your thought on that and refi versus purchase?
Yeah, we haven't seen that in the data that we have available to us in terms of employment. What we've seen is a decline in mortgage industry employment over the last 3 years, a decline of about 36%. And now it's just leveled off. So we're not seeing a lot of staffing up. But I think with all of the volatility in the markets right now, we are going to have these green shoots of opportunity. There could be cash out refinance opportunity. Right. There's definitely ARM opportunity too, even borrowers going from fixed rates into ARMs.
Interesting.
And we're also seeing home equity opportunity as well, because homeowners are sitting on $36 trillion of accumulated home equity. So there are potential, but in terms of the refi boom, it's going to be these small green shoots of opportunity, sort of like what we saw last month.
I think that's really interesting because in your on the panel, you guys made the point that when those opportunities come, people jump on them. It's a very short-term opportunity, and then it goes back to maybe a more normal mortgage rate. So people have to be prepared.
You have to be prepared, especially when it comes to jumbo borrowers, because they're the first ones who will want to refinance. So recapture has historically not been very good. If you're servicing the loan, maybe 1 in 5 loans is recaptured. Maybe the trigger leads legislation will help. That goes into effect in March of 2026. So if you're a servicer or an originator or a bank with the bank customers, that might help a little bit. But I think there's a way to go. There's a lot of room for improvement. We've heard so much at this convention about AI and predictive analytics. Well, it's really now more important than ever when those opportunities come to take advantage of them.
When you talk about the recapture rate, I feel like we have been battling that. You've been talking about that from the stage for how many years? When is that going to change?
I know. It reached its peak. It was in its mid-30s with the HARP refinancings back in 2012. But I do believe there's so much more data that lenders are getting on borrowers and propensity of borrowers to prepay that I do think, and with this legislation, the trigger leads legislation, we could see that hopefully pick up. But it's really essential to stay in business, to be a good performing mortgage company in this market.
And I think that it's top of mind, maybe because of the trigger leads bill, but it seems to me that it's much more top of mind for people now than maybe sometime in the past. It seemed like, how can you be laissez-faire about that? This should be your number one job, right? Is to make sure that the people you've served before come back.
That's absolutely right, Sarah.
Okay, so you mentioned the number of people that have left the industry or have been let go, whatever, and you guys have been tracking that pretty closely. I remember in 2023, it was some pretty harsh statistics that you guys were like, this is what probably has to happen to match the origination level. About where did you come out on that?
We did pretty well. We did an analysis and we were in the low 30s. It was a little bit higher at 36% based on the BLS data, but we're also tracking employment based on the NMLS data on number of loan originators, as well as our quarterly performance report data. Now for independents, that drop in mortgage employment was more severe. So we were more in the range of 43%.
Wow.
Banks tend to hold on to their employees because it's part of their culture, but they also don't staff up. So that explains some of the differences between our various data sources on employment. But I think it's steady as you go. I'm not hearing a lot about staffing up, though.
Okay, well that's
not
interesting.
yet.
Well, it was anecdotal. People talking to me saying, "Oh, this lender has, hired all these people." So
Yeah.
Anecdotal.
Now that said, there could be more consolidation in the industry. We saw that in the Home Mortgage Disclosure Act data, where in terms of the number of just non-depositories between 23 and 24, it dropped by over 70 companies.
Wow.
So it could be there have been some very high-profile M&A deals, but there could be smaller M&A deals taking place, and there's just not as much splash in the trades about it. But it could be, again, volume is not going to there's not going to be a huge pickup in volume. It's certainly going to be better than what it was this year and last year. 8% is something. But at the same time, it's very important for those the companies out there to be performing and have that net financial income, because you can't continue to have 10 quarters of net production losses indefinitely, right? Which is what we saw. Yeah.
Well, let's talk about affordability, which hopefully will help this origination. That's what you're looking at. So what part of the overall picture do you say, here's where affordability is getting better?
It's tough. Housing affordability continues to be a challenge. Now, in terms of housing inventory, we're expecting less in terms of home price appreciation.
Okay.
At some points, we were seeing home price appreciation year over year in the high teens, so it was very high.
Yeah.
Now we're expecting it to be flat to slightly down, but it's really relative. It's important to understand it's different depending on where you are in the country.
Okay.
So, for instance, if you're in the Midwest or if you're in the Northeast, where it's harder to build, inventory is still very tight, and affordability conditions are tough there. Whereas Florida, Texas, Colorado, they're actually seeing some depreciation overall, so there's more housing inventory available. So that helps to some extent. At the same time, the economy is slowing down. We have issues not only with principal and interest payments, but taxes, insurance, condo fees, HOE fees. So it complicates the equation in terms of affordability. But certainly rates stabilizing, we're not expecting a huge increase. It's probably going to stay between 6.5% over the next 3 years. So that is encouraging, and just the fact that there is still demand to buy homes. Folks want to buy homes.
There is that pent-up demand when you think about the buyers we've been missing over the last 4 or 5 years. Like, at some point, those people have to get a house, right? They have to move up, they have to move down, they have to do all those kind of things. So we do have some of that pent-up demand, I think.
And at the same time, existing homeowners can't stay put forever. We've been talking about how no one's moving because of their low rate mortgage. Well, things happen.
Right.
We were at a floor. There's death, there's diapers, there's all the D's, divorce,
right?
You name it. And so there are life events that happen, and people need to move, and they can't postpone their lives indefinitely. And moving forward, they'll need to move even if they're locked into a low rate.
I think rates are so interesting, right? It's all relative. Of course, people who have been in the industry since the 80s, they're like, these are not high rates. Stop calling them high rates. But like, for, if you're used to like, 3, 4, 5, these seem like high rates. On the other hand, what was it? 18 months ago, 2 years ago, we had 8%. It reached 8%.
Yeah.
So compared to that, low sixes is great.
Yeah, well, at the same time, they say, yeah, but the average loan balances are going up.
True.
So
that's true. I mean, it is
complicated.
It is a complicated thing. What else are you looking at, like the broader economy-wise, that could affect the housing market?
What happens in terms of the overall economy? What the impact of tariffs on the economy. Inflationary pressures.
Yep.
There still are those inflationary pressures, even though right now, if you think of the dual mandate of the Federal Reserve, which is price stability and full employment, it's leaning more towards employment. There could be those inflationary pressures that could potentially lead to higher rates. But again, we're expecting a steeper yield curve is what we're expecting, just a steeper curve in general. So, we'll see. And any type of announcement coming out of Washington or could cause additional volatility. So.
Yeah, you guys put on events, we put on events, and there's always this thing where, you send out questions, and if it's about an economic or, political topic, and then you're like, listen, let's talk in the green room. Let's talk before we get on stage, because anything could happen at some point. And we know that it's a very volatile environment as far as like things change quickly. There's a lot of action being taken by this administration.
Absolutely.
And so, it's a little bit hard to predict.
You're absolutely right. And we're going to have a new Fed chair coming in very soon.
Great point.
Who knows? Yeah, we'll see what happens with that.
Let's talk about profitability, right? This is a great topic.
Oh, near and dear to my heart, Sarah. Thank goodness.
So what are you seeing there? What are you forecasting for 2026?
Oh, goodness. Well, thank goodness we don't officially include profitability in our forecast. But what I would say is that second quarter data, which is the most current we have, things were heading in the right direction, and then it was about 25 basis points of net production profits, which translates into a little less than $1,000 a loan in profit. But there is so much variance. There's a big variance between the top performers and the bottom performers. So the top performers, economies of scale helps. It helps to have larger loan balances. It helps to have some non-agency product. We've heard a lot about that at this convention, pros and cons associated with that. And so there, and it also depends on which production channel you're in. Broker wholesale is doing very well. So lots of variance, I would say, between the top and bottom performers. But third quarter, I would expect to be pretty good. I've heard from a lot of lenders. We don't have the data yet for the third quarter, but I imagine that we'll be, in the black in the third quarter, just because we had that refinance boomlet. So that should help. Again, it's hard to predict profitability going forward other than to say that volume will be up, and so that certainly will help the industry overall. But we'll see. Hopefully no more of the 10 quarters of net production losses. But
yeah, I was going to say, when 25 points is like, we're excited about that.
I know.
It just shows you where we've been. I am excited about it. I'm glad. Obviously we hope people make money, but it's rough.
Yeah, a big part of it, I would just say, Sarah, a big part of the profitability equation is not necessarily revenues. Revenues are decent.
Right.
350 basis points is kind of the average that we have from 2008 to the present on a simple average basis. So it really is managing that cost, that cost per loan. So even though gross expenses have dropped between peak and trough, 40%, those expenses have really come down. It's still those per loan costs that look disproportionate. And there's also issues with pull-through. If you look at look at the closings to applications, pull-through's been dropping. So there's a lot of work being expended without a final product, so to speak. So hopefully, again, with technology advances, we'll get smarter. We'll know when these applications aren't going to close, but pull through is tough. That's really dropped over the last 3 years.
Do you attribute that pull through drop to just that they're shopping more, that they're filling out more applications? Like, what do you see in the data?
They are filling out more applications.
Okay.
That's what I heard from some of our lenders, but it also could be denial rates. It could be that they didn't think about the cost associated with taxes and insurance and all those additional fees. So that's a big part of it as well.
That makes a lot of sense. Marina, thank you so much for joining us today. I really appreciate it.
Oh, it was wonderful to be here. Thanks for having me.